Hello and welcome to the Open the Gates February 2026 UK property market update, where I'm going to be discussing all things February house prices, activity levels, mortgage approvals, transaction numbers, and we're going to be looking at some year-to-date data as well. So let's jump into it and I will start sharing my screen. Right, so here we go. So February 2026. So, for those of you who are new to the channel, left-hand side is month versus month, middle is year versus year, and then the right-hand channel is February 26 versus the 21-26 February average. So stock levels are up across all three metrics, still considerably up on the average. So we've got elevated stock levels, depending on which data source you look at. We're looking at a decade dozen year high. Depends whether you're a glass half full or a glass half empty when it comes to this, but really positive that the stock levels are the way they are in the market because most sellers are also going to be buyers, which is helping activity levels and more sales take place. It means buyers have got more choice as well, which will bring them to the market because around 76% of buyers don't list their own home until they've found somewhere to buy. So that's a positive. But sellers need to remember elevated stock levels mean more competition and more choice for buyers means that they're going to have better negotiating power. So I've said it before and I'll say it again, we're in a two-speed or two-tier market. Those who price correctly from the outset are selling, and those who price on top of the market are making everyone else look better value for money, who's more realistic and more motivated to move. So they need to make sure that their pricing is correct from the outset. New listings, really, really positive to see, up on all metrics, almost 5% month on month, 3.3% year on year, and then 10.6% on the average for February. So shows that sellers are not deterred by everything going on politically, economically. They are coming to the market, which is really, really good to see. They're moving their best foot forward, which is really, real positive. Sales agreed up just over 15% month on month, which is really positive. You'd expect that. February is normally going to be a busier month than January, but it's good to see that buyers are taking action as well. Lower interest rates, higher wage growth, inflation coming down, better affordability, and more choice for buyers is making more sales happen. It is down 2.1% year on year and 1% on the Feb average. So a couple of bits on that. 21, 22 were crazy because of COVID, and 25 was crazy because of the stamp duty deadline at the end of March. So those figures were being artificially inflated. February 23 would have been tough due to the hangover from Trustonomics. But it shows that we're in a pretty stable market, all things considered. And when you factor in where interest rates are now, so let's say people coming off of 5-year fixes, for example, they're coming off interest rates with a two in front of them and now looking at interest rates with a four in front of them. So it shows that there is still activity happening. And without going off on a mad tangent here, when it comes to data, when you look at the historic trends, higher interest rates haven't necessarily meant less activity in the market. There's definitely demand out there. Sure, it's more challenging, and that's where great agents are going to do really, really well. They're going to make deals happen. I think it's an order making market, not an order taking market that we would have seen in 2021 and first half 22. Price reductions. So this is interesting to see down year on year and month on month. So 3 to 4%, which maybe shows that sellers are being a little bit more realistic from the outset. February asking prices were below the decade average according to Rightmove, and they were steady. There were obviously some big asking prices in January. I think the biggest ever January on record according to Rightmove. Um, and I think the highest monthly increase to an average asking price, I'm going to say it was since June 15 off the top of my head. But yeah, less price changes happening, which maybe suggests more realism from the start. Or actually, it means maybe state agents need to actually be working their stock a bit more. Price reductions are still a thing, though. They're up 29.5% on the February average. So it shows that as interest rate environment is higher, there's more stock out there, and buyer demand isn't what it was a few years ago. But more sellers are having to adjust their price to entice buyers. Withdrawn data massively down across all metrics, which is really positive to see. For me, that means there's a lot more committed sellers in the market. These aren't just sellers who are going, we'll stick it on and hope for the best, see what happens. I think these are serious sellers. And yeah, if they're not selling, they are being more committed. The data from 20A has highlighted actually, so I just need to find this on my other screen. I put it in my LinkedIn newsletter. So um, the 2026 data. So let me just find where I am. The 2026 early data from 28 shows that property is taking longer to sell compared with last year, increasing to an average of 91 days in January this year versus 87 days last year. This is the highest time to sell in the last 10 years. So property is taking longer to sell. There's more price reductions happening. That's what, and sellers are not coming off the market, which is why we're seeing elevated stock levels. So it's interesting when you look at one part of the data, it basically has a knock-on effect to other bits. Now, fall throughs, again, positive to see month on month, year on year, fall through numbers are down, which again, I think shows that the market's not as fragile as people think. And whilst there's going to continue to be fall throughs, as you can see, 3% more than the February average, buyers and sellers are not just pulling out willy-nilly. They seem a lot more committed at the moment, which is really, really positive to see. Relisted numbers for properties re-entering the market has been slow in February, which is interesting. So there's been less properties withdrawn from the market, therefore there's going to be less relisting. I've been saying this for a long time now. Get ahead of the curve, target withdrawn properties. So those ones that are in your database, target. The ones that are not in your database, target. Don't just send them one letter. Keep sending letter after letter after letter. These are paused moves. They will still want to transact. And as properties are staying on the market for longer, don't just, I find that a lot of agents might send letters at 12 weeks on the market, 16, 20. They'll then give up. Keep sending letters, even if it's been on the market 6, 9, 12, 18 months. If anyone wants any data on how long properties have been on the market for in their area, please do drop me a message and I'll highlight to you. There's so much opportunity there. And I find a lot of estate agents will say, why would I target those properties? Um, the seller's not that motivated. They probably want too much money. That might be the case, but I'd want to have a conversation in their living room, look in the whites of their eyes, and get a feel for that myself. Because a lot of the time they would have had just really, really bad advice from agents. And on that point, latest data from Rightmove that they released at a Liverpool Property Mart regional conference last month, 29% of properties are selling with the second agent. And then the latest data from Rightmove as well, reduced properties are 3 times more likely to change estate agents. So some good data there in terms of giving you some insight into who and what you should be targeting when it comes to on-market prospecting. Right, on to prices. So average new asking price at 423,666. That's up 1.3% month on month and 2% year on year. So pretty steady there. And then the pounds per square foot is up 0.5% month on month and a whopping 8.6% year on year. So yeah, it's showing that sellers are trying to ask a little bit more, as they always do. But yeah, a little bit of growth there is a positive sign. That's going to bring more people to the market. And then sales agreed. So average asking price sits at 355,428, 1.5% monthly change. Interestingly, from a year-on-year perspective, down 0.1%. So it shows those that are selling are being very realistic with their price, and then perhaps those sellers who are wanting too much money, overinflating their price, are just sat there. So you got to price competitively. Pounds per square foot is sat at 347. That's down 0.6% month on month. It is 1.2% up on a year ago. Right. Mortgage approvals for house purchases on the 12-month and 10-year. So I'm just going to read off of my other screen because I've got, again, from my LinkedIn newsletter. So mortgage approvals for house purchases fell to 60,000 in January. That's down from the 6-month average of 64,100. And it's representing a notable softening across almost every measure that I look at. Month on month, approvals dipped 1.6%, and whilst volumes were 5.76% below the 12-month average and more than 10% below the 10-year January average. So the year-on-year picture looks more striking on the surface. Volumes are down 9.37% compared to a year ago, but that month was artificially inflated by buyers rushing to complete before the stamp duty threshold changes took effect at the end of March. And that pulled forward a significant volume of activity and makes it a flattering comparison rather than a reliable benchmark. Net mortgage borrowing has also eased, falling to 4.1 billion from 4.5 billion in December. However, the cost of borrowing continues to move in the right direction. The effective interest rate on newly drawn mortgages, and that reflects what borrowers are actually paying rather than the headline rates. It fell to 4.09% in January from 4.15% in December, whilst the rate on the outstanding stock of mortgages edged down to 3.9%. Gross lending held up reasonably well at £23.4 billion, marginally above December's figure, suggesting that while few buyers are completing, those who are proceeding are borrowing with growing confidence as the affordability picture improves. So the approval data points to a market that is still digesting the after effects of the autumn budget and the uncertainty it created through the final quarter of 2025, rather than a market facing a fundamental loss of momentum. Mortgage rates continuing to fall and product choice at record levels means that conditions are in place for mortgage approvals to recover as the spring market builds. So that is the mortgage approval data. And then transaction numbers, so 12 months and 10 year. If I just quickly reel this off as well, although I do just need to work out something on this. So bear with me whilst I do. Perfect. Right. Okay. So transaction numbers. January transaction levels were 5.73% down month on month, 0.545% year on year, 4.41% on the 10-year average, and 5.67% on the 12-month average. So those figures tell a story of a market catching its breath rather than one losing momentum. The 5.73% monthly drop from December is largely unremarkable, as January traditionally sees a seasonal dip after the end of year push to complete. More telling, though, is the year on year comparison. Transactions were down just 0.45%, essentially flat. Which is a creditable performance when you consider that January 25 was inflated a little bit by buyers racing to beat the stamp duty deadline at the end of March last year, as I've already said. If you strip out that artificial urgency and the underlying picture actually looks pretty steady. The 4.41% shortfall against the 10-year January average does warrant attention, but it's not alarming. It reflects the cumulative impact of higher borrowing costs over recent years in a market that's still adjusting after the stamp duty changes took effect. Mortgage rates are continuing to edge down, wages are outpacing property prices, and buyer confidence is recovering to its strongest levels seen since the autumn. And the conditions are in place for transaction levels to again build through the spring. The market may not be firing on all cylinders just yet, but I would say the engine is definitely warming up slowly but surely. Whilst the January figures represent the first significant monthly fall since activity stabilised in the summer following the stamp duty deadline, they need to be seen in the context of a year which, as a total housing market, transactions were still 10% higher than 2024, and the broader trajectory remains upward, even if individual months will inevitably fluctuate. So that is the transaction data. Inflation has dropped to 3%, which is positive to see. So that's now at its lowest point, just looking at my other screen, um, since March last year. So we're at like a 10-month low for inflation, which is really positive to see. Obviously, there's lots going on in the world at the moment that could impact all sorts of different things here. But I think what the UK property market has shown over the past decade with Brexit, COVID, and the wars that are going on across the world is that these more recent black swan events, we've shown that we can cope with it a lot better than the worldwide recession of 07, 08. Right, last bit, house price indexes. Rightmove sat at 368, virtually exactly the same month on month, year on year. Zoopla, same month on month, 1.3% up annually, so a little bit of growth. Land Registry, so their data, which is to the end of December at 270, down 0.7% month on month, but 2.4% up annually. If you'd said to me at the start of 2025 that Land Reg data would end at 2.4% growth, I'd say that would be a very good result. Nationwide sat at just above 273, so a 0.3% monthly increase, and then 1% above the annual change. And then lastly, Halifax at 300, 0.7% monthly increase and 1% annually. Caveat on this, the Halifax data is the Jan index. I probably say this each month. The Halifax house price index doesn't come out for a few days after I record this. So that's why I've done the one from last month. Home.co.uk and eServe haven't released any updates, so I haven't included those. So the average is just shy of 297, monthly average increase of 0.06 and annually 0.94%. So to round that off, activity levels, prices, mortgage approvals, transaction numbers, all pretty steady. Some are up, some are down, but it just shows that there is definitely demand out there. There is a market to be had. And it is, as I said earlier, a market for order makers, the world-class estate agents to go and have brilliant years. The agents that are order takers and just reliant on sticking something on Rightmove and hoping for the best, they're perhaps going to struggle this year, but that gives much more opportunity to the high-performing agents. And I assume those are the ones who are going to be listening to an update like this. Right, final part of the update, the house price indexes. So onto Rightmove. So prices are up 2.8% since December. So whilst they remained flat in February, we had obviously a big increase in January that I have already reported on. Let's just zoom in on this. There we go. And it's still been the strongest start to a year for asking prices since 2020, I should say. Rightmove talk about wages outgrowing house prices, stock levels being an 11-year high. I've already sort of touched on that. Lenders are reducing rates. They're also looking at various different ways to allow buyers to borrow more. So increased buying power is going to help with buying demand and activity. That doesn't mean if sellers are reading that all of a sudden people can start spending more money. It's not going to be higher budgets. It's going to be better sentiment, increase positivity and higher demand rather than increase expenditure, I would say. Right, and then the other bit that I want to touch on here is where is it? Yeah, so I've already kind of touched on this, but let's just highlight it. So I think it's really important. So February's prices were at a standstill compared with a typical 0.8% February rise over the past decade. That follows the record January price jump that happened last month, I've already talked about. It emphasizes how large January's price increase was. So the first 2 months of 2026 combined is still the strongest start to a year since 2020, and up 2.8% since December, as I touched on. Price growth at the start of the year has been front-loaded more than usual due to the early year boost in buyer and seller confidence as budget uncertainty ended. And then that's been supported, and this is really, really key, by Rightmove's monthly confidence tracker, which measures the sentiments of homeowners, renters, prospective first-time buyers, and landlords towards the market. It showed that net confidence amongst buyers and sellers in January returned to its highest levels since September 2025. And in February, January's price gains have held, but new sellers have refrained from further increases to prices as market realities set in. Competition amongst sellers remains at an 11-year high. So, as I said, depending on what data you look at, decade to a dozen years. Buying activity is lower than this time last year in 2025. That was after the early year rush to complete purchases before stamp duty changes. Right. I do want to look at this though. Where are we? So number of new listed properties for sale is just below this time last year, but it's 11% higher than 2 years ago. And then similarly, the number of sales agreed is 5% below 2025, but it's 9% higher than 2024. So once you sort of take out all the different things like stamp duty deadlines, increasing demand, budgets reducing demand. When you kind of look at all of that, it just shows that the market's actually in a pretty good place. Obviously, caveat on that is any crazy black swan events that could impact that. And then, as I touched on already, the FCA is currently conducting a mortgage market review, which could lead to changes to the mortgage market. And ahead of that review, the Bank of England and the regulator have introduced measures in 25 that gives lenders greater flexibility on loan to income limits and stress testing, should I say. Lenders are also continuing to look at innovative ways to help buyers, including through very small or no deposit mortgages, to allow some eligible borrowers to access up to 6 times their income, which I'll come on to in a little bit. Last thing on here, I point it out occasionally, but if we just look at average monthly spent on first time buyer home versus rent, you can see that for the past 2.5 years now, since interest rates obviously spiked, if you've got a 10% deposit on a first time buyer home, it is cheaper than renting. The Zoopla data will confirm that as well. And affordability to buy a first home, roughly 2/3 of properties purchased are on joint incomes. When you look at the joint income here, and borrowing that is possible compared to the average asking price of first time buyer home. That is why first time buyers are still so active in the market. Okay, on to Zoopla. Zoopla reported strong sales numbers, supported by average mortgage rates dropping below 4%. They've now shown that 40% of homes for sale are now cheaper to buy with a mortgage and rent. Kind of just touched on that. And sales activity is pretty healthy, with house price inflation remaining subdued at about 1.3%. So if we scroll through this, um, here we go. So this bit here, number of sales agreed has increased sharply, but it remains 3% below the very strong start to 2025. Sales are currently running at the fourth strongest February level in the past decade. Really positive to see, even though there are 8% fewer buyers in the market than a year ago. So whilst there's fewer buyers, those who are in the market are definitely having an appetite to transact, which is really, really positive to see. And then Zoopla highlight that there's 6% more homes for sale versus a year ago, and they're expecting that to rise in the coming months as well. Again, if there's more reductions, less withdrawals, potentially more fall throughs with sale agreed numbers, that is just going to mean stock levels are going to increase, along with new listing numbers and sellers returning to market, I think, as well. So they touched on the lowest mortgage rates in 4 years has helped support sales. So if you look at those 2-year fixed rates in 26 at 3.91%, having those below 4% is a real psychological barrier. Yes, this is a 75% loan to value, but the amount of the market that is at 75% loan to value or better is actually very, very strong. Obviously, if you compare it to prior to 2022, there were rates at 75% LTV below 2%. So anyone coming off of 5-year fixes, yes, it's going to be a bitter pill to swallow. But those coming off of 2-year fixes are saving a little bit of money. I've already touched on it, but the stress testing. So usually it's at 8.5. Sorry, usually last year it was at 8.5%. It's now at 6.5%. So if you now look at the stress testing across GB, it means that 40% of homes are in reach of first time buyers that are actually less than the cost of renting, which is why we're seeing so many more first time buyers return to the market. If you read my LinkedIn newsletter update, there's lots of positive data from Connells, from Nationwide, talking about how many first time buyers are there and how it doesn't appear to be stopping anytime soon. And then improved affordability as well. Increased supply with up to 16% more homes available in some areas has meant that price growth has been pretty modest and is going to stay that way. And then if you look at earnings, they have outpaced house prices for over 3 years now, which is really, really positive to see. So increased wages, house prices pretty stable, interest rates coming down. That has improved affordability, which is why we're seeing more buyers come to market. Again, in my LinkedIn newsletter, it goes into more detail around the types of buyers returning to market. So those existing homeowners looking to upsize, buy a bigger property, spend more money, borrow more money, which is positive for a healthy market, particularly from a fluidity point of view and transaction numbers. I hope fluidity is actually a word. Right, on to the last few bits. So nationwide annual house price growth unchanged at 1%. House prices up 0.3% month on month. And then the key thing I want to touch on is what I've just been saying about transaction types. So if you see mover with mortgage, you can see how that number has increased. First time buyers on the up as well. Buy to lets, whilst they're perhaps not what they were in the pandemic or before, they actually are pretty steady. And it does appear as if the mass exodus of buy to let landlords from the market didn't actually really ever happen. Again, the data is in my LinkedIn newsletter about that from 20A. So nationwide, looked across 2025 as a whole, the total housing market for transaction numbers were 10% higher than a year ago, and their housing affordability report showed improved affordability and an easing in credit availability, and that's helped support first-time buyer activity, which more with mortgage completions up 18% year on year. So what I touched on. And then up here, cash transactions last year at a similar level to 2024. In recent years, there have been something of a decline in the share of cash purchase, which accounted for 35% transaction in 2025, down from a peak of 42% in 2023. So as interest rates have got lower, more buyers have come back to market with mortgages as borrowing that money has become a little bit cheaper. If you look at the UK house price to earning ratios, again, it's still below the 25-year average and significantly down from the peak of 22-23. So it's kind of between 5.5 to 6, whereas it was at 7. So positive there from Nationwide. Right, Halifax, UK house prices up 0.7% month on month, 0.1% quarterly change, and annually 1%. So the Halifax House Price Index has actually reported £300,000 barrier being hit for the first time. Amanda at Halifax says the housing market's entered 26 on a steady footing, with average prices rising by 0.7% in Jan, more than reversing the 0.5% fall seen in December. Annual growth is also edged higher at 1%, pushing the cost of a typical UK home above 300 grand for the first time. So whilst that's undoubtedly a milestone figure and activity levels show a resilient market, affordability does remain a challenge for many would-be buyers. The broader economic conditions continue to provide some support. Wage growth has been outpacing property price inflation since late 22, steadily improving underlying affordability. That's a positive trend for buyers and the long-term health of market. We're now seeing more mortgage deals below 4%, and if inflation continues to ease, there should be a gradual reduction as the year goes on. All in all, Halifax thinks house prices are likely to still edge up between 1% and 3% this year. If you look at the bit below then as well, how did we reach a £300,000 average property price? I think this is important to know because, again, a lot of the growth was front loaded or in that middle part, should I say. So between Jan 20 and Jan 23, that crazy COVID time is where we saw so much of the growth. And then since then, that's where we've seen the weakest amount of growth. So anyone who bought a property in the past few years who's looking to transact again, they need to realize we're in a completely different market now to what we were 5 years ago. So Amanda goes to finally goes on to say, first time buyer, the headline numbers can seem daunting, but it's important to remember that most are looking at smaller properties in areas that reflect their budget. Many locations offer far more accessible price points, especially in northern regions where homes can be found for under 200 grand. So northern regions have done very well in the market in recent times. They perform a lot better in higher interest rate environments. And then lastly, she goes on to say affordability is still obviously a challenge, but the stronger wage growth and falling mortgage rates have helped relieve some of the pressures in recent years. They expect that improvement to continue in 2026, meaning that with the right support and advice, home ownership should become a realistic prospect for would-be buyers. So if you've got anyone out there who's saying, I wait for interest rates to drop significantly, I wait for house prices to come down, it would have cost them so much time and money over the past few years in doing that. House prices are increasing steadily, mortgages are dropping a little bit. If you waited a year from now, whilst interest rates are lower, house prices will be a little bit higher. You're probably saving a few quid on your mortgage, so you might as well get on with it, not have your life on hold, and actually be putting equity into a property rather than sitting and waiting. Right, last but not least, UK house price index summary. So the data from February is the end of year data for 2025. So the UK house price index ended 2025 on 270 grand, up 2.4% on a year ago. It was down 0.7% on the month, but that's how we ended the year. So you can see a pretty straight line here on the graph. And then from a data table, it's gone up to from 264,936 at the start of the year. So let me just quickly work that out. Should have done this before recording. So that's a £5,323 gain. So if I was to say over 365 days, that's a £14.58 increase per day, tax-free in your main residence. And if I want to go really, really crazy, that's 61p an hour. So let's say you get 8 hours of sleep a night, you earn £4.86 every night just by going to sleep, based on average UK house prices. So that is my February 2026 Open the Gates property market update. I will be back in early April where I will be reviewing March year to date and Q1 figures. If you have any questions at all on this update, or if there's anything you want to see included or excluded in updates going forward, please do give me a shout. And thank you very much for watching as always, and I will see you again next month.